Hello, this is Coach Mike from WinningStockCoach.com. Going to start off this week's market overview video looking at the weekly chart for the SPX. That's the S&P 500. Now, I want to point out something that I mentioned last week, the swing point from the SPX weekly chart that was really at this point our critical support level. That value was 1985 and 44 cents. We did dip below that on Friday during Friday's trading day, but we managed to close the week above it at 1985.54. So at this point in time, that value would still be considered our support point. Now, I do want to also discuss a couple technical things based on some target values and support and resistance values that I've mentioned in the past few weeks. The first is this 2703. Over the past 8 months and 2 weeks now since I've been producing these weekly videos, I've been within 0.5% on the S&P 500 for high and low target areas. The 1908.47 we saw about 5-6 weeks ago, it didn't go very far below that, and we had that projected a few weeks in advance to prepare for it. Now, I had the 2027.03. We didn't quite hit it. 2011.17 was our high. Not quite 0.5%, but pretty close. And the other technical aspect I'd like to point out here is the chart pattern that is known as an evening star. It's a 3-candle chart pattern, which we see here over the last 3 weeks for the S&P 500. Now, a true evening star is traded not just on the 3-candle pattern, but on the continuation from it. So even though this is a bearish indication, it is an indication or a chart pattern that needs to begin with continuation. Now, as far as the weekly chart for the S&P 500, we've only seen over the last 2 years the evening star pattern one other time. That one other time was back here, right back over here in May of 2013, where the evening star pattern completed the week of May 27th. And even though you had a green week the following week, you had that continuation and the continuation further downwards. So let's talk about where that downwards target might be at 1924.56, which would probably run us right along a line with this trend line I have on my chart. That'd be our first targeted support area should our swing point on the weekly chart fail. And we're going to have to leave our 2 high side potential targets at 2027.03 and 2033.81 intact at this time, because we haven't yet reached them or confirmed a pullback. Now I'm switching over to the daily chart, where each candle represents 1 day on the SPX, the S&P 500. And from the start of this past week, you see the fall on Monday and Tuesday, a slight rise Wednesday and Thursday. And if you were following the volume being traded, like if you were following the SPY, SPY, it's the Spider S&P 500 ETF, you'll see that this little up move was very low volume. And Friday was a pretty decent volume day, just exceeding Tuesday's volume. And the other thing I want to show you about the up move that I found particularly interesting, if you ever use Fibonacci retracements or have heard the term dead cat bounce, it's when a falling stock makes a rise that does not exceed a 50% retracement before pulling back again. And it's typically an indication where simply during a fall, the stock bounced a little bit to kind of relax and give it more strength to continue the fall to a new low. If you look at where we closed on Thursday actually completed the dead cat bounce. Friday opened with downward pressure, which was a textbook dead cat bounce opportunity for both the long and now the short. And because we closed below this previous zero line that marked the dead cat bounce, the drawing's removed, and we can kind of give ourselves an interim target area by marking our prior high, the low before the dead cat bounce, and the high of the dead cat bounce, to see that we may, should we fail that weekly swing point I was talking about, the 1985.44, see 1969.47 before we get a little bit of an up move, even though that up move may only be a retest of the failed support of the swing high before making its way down again towards that longer target, 1924.56. Moving over now to the Dow Jones Industrial Average chart, the DJI, came pretty close on our first target area, 17,209.51 cents. We hit 17,161.55. I'd say that's pretty darn close. The one thing that I want to show on this weekly chart is, again, the evening star pattern that we have present on the weekly chart, that unlike the S&P 500, where there's only been one evening star over the past couple years, we have two on this chart. We still have that same one in May 2013, but we got another one in early August 2013. This evening star pattern, both had continuation, but again, with the evening star pattern, we have to see the continuation before confirming the validity of that technical chart pattern. Now, the other thing I want to point out is this move that was made here. This down move, the up move only to the prior highs, even though you can say, well, it got a little bit higher than it did before. Visibly, it looks very close to the same value, and then has seemingly pulled back from it. Now, if it were to break the lower range of this prior highs 3-4 week consolidation area, it would confirm what is called a parabolic move or a double top, but you can see this parabolic half of a sine wave created here, and the pullback from it could be a pretty extreme sign of weakness, especially should the Dow Jones Industrial Average, the DJI, retrace more than a value of 50%, or around 16,810 and change. So that'd be the area we'd be watching to see if it simply does a 50% retracement, or if it fails that area. And if it fails that area, that's going to be an extremely bearish confirmation. And looking over here on our daily chart, on our 6-month daily, what we can see here that's a little more evident from what I was talking about on that weekly chart, we got up into this consolidation range, and after the market dip late July, early August, and our nice solid run up, we have failed to break the prior daily high close. The Dow Jones Industrial Average did not make a new daily high close in this run up before this pullback. And if it were to fail that weekly chart's lower end of the consolidation, which is really at the equivalent of 16,947.08 cents, we would begin to see another pullback, more than likely suitable and replicating to what we saw over here at the end of July and into early August. Now, if you've been watching my market overview videos over the past several months, you've heard me talk about how the S&P 500 and the DJI over the past couple years have lagged a specific indice that you may not expect it to, and I wouldn't have expected it to. And historically, it hasn't been this way, but over the last 2 years it has. And that's the Russell 2000, the RUT, which is the small cap index. Now, what I want to show on the Russell 2000 is I get my chart marked to, I'm going to go to a 2-year weekly chart. You're going to see a period of time since the inception of QE3, the quantitative easing that's currently being tapered from. And when we got back into December and January, I began talking about how I felt there was more risk than reward in small caps. So I sold my small cap positions at the beginning, or the middle actually, of January. And even though they went to a higher high, the index in general, what you see is you had a very abrupt fall the very week that I had put out my risk alert on small caps. And even though it rose up over 4 weeks or so to a new high, what you've seen since, this nice ascending, a big angle on this uptrend. And since, what have we seen? Horizontal movement. Last week, I covered on my market overview video in relation to the Russell 2000 that on each of these last two up moves for the daily chart of the Russell 2000, that even though it's not a straight up or straight down thing, and even though there are going to be ups and downs, the process of the up moves always resulted in a higher high, higher low, higher high, higher low, higher high, higher low, higher high, and as soon as a lower low was made, you knew that the run in that indice had completed. Well, rather than getting up into where we had previously double topped, which would have been this upper horizontal trend line, we came down last week and made a lower low. And since that market overview video, we simply got a run back up into the trend line, just like last week's market overview had told you to watch for, a pullback from it, another run for a double top here, and a pullback from it. At this point in time, this uptrend that had been created in the current up move has been broken. And as it seems, a new trend has been established on the daily chart of the Russell 2000. And that trend line is definitely pointing in a different direction. So, pretty important to see that the affiliation with the weekly chart on the Russell 2000 and things I had put out last January, or this past January 2014, where I had the concern after falling out of the QE3 channel that even if it ran up that time to make a higher high, the trend on the index would be changed. You can go back and watch my public videos on my YouTube channel. That information's there for you. And even though it went up to make a higher high, the trend has changed. I've talked many times about how the S&P 500 and the DJIA have lagged the Russell 2000 over the last couple years, even though that's not a historically accurate indicator per se to use. But as we go to the S&P 500, you remember that purple dashed channel that I had on the Russell 2000 that started at the inception of QE3, quantitative easing, the third series, the one that's currently being tapered from. And even though it's been 5-6 months since we saw the Russell 2000 do it, we have begun to see a fallout of that QE3 channel, the rise to a higher high, but the more rapid sense that we may be pulling back. Now mind you, these prior up runs, the red candles were tiny. They did not exceed the lows of the candle before them till here, at which point in time it was just a matter of time on tiny little green candles before we pulled back. The red candles on this run didn't exceed the lows of the candles before them until here, which was just one fluke of a pullback. But here, the first red candle that we get in this series is a candle that gives us a technical chart pattern that we simply can play the continuation off of as a bearish indication. And we see it again failing out of that QE3 channel. And ironically, if we take this down to a little bit smaller time frame so you can see it a little better, we're going to go to a 2-year weekly. You'll see that the angle of this trend has fluctuated and can simply be demonstrated across the tops since the end of 2013, and though still an upwards overall direction, not the same intensity we saw over the last year and a half. And it's something to be very aware of as an investor, because just like that Russell 2000, the RUT, that channel went from upwards to sideways. As you start to find that change in direction, your investment tactics, the trade plans for your longer term investments, will need to change. And that's a very, very, very important thing to stress. People that didn't follow that advice back in 2008 lost a lot of money. And I'm not saying time to sell everything. You did not hear that out of my mouth. What I'm saying is the plans you have for those trades need to change. You need to identify within your trade plan where your support is. You need to identify the current direction of your trend. And should that trend change to a downwards direction, which on this Russell 2000 may have very well just happened, you may want to be observant of your longer term investments and for the approach that you'll be taking in relation to them. Finally, moving over to the COMP, our NASDAQ composite chart. The NASDAQ's been extremely strong. There's no doubt about that. We covered the NASDAQ for the breakouts off this retest. For momentum trades, we had the initial momentum trade, the retest for more momentum. And really the past couple weeks have just been slow and slightly red, without really any confirmation at this time that we'll definitely see a pullback. But we can definitely see the momentum has changed. That strong, aggressive upwards momentum stopped and went sideways. When we take this over to view it on our daily chart, we'll see that now for nearly 3 weeks, actually for exactly 3 weeks, since this last momentum play was granted, our highs and lows have stayed fairly consistent in a horizontal channel. And the best way to trade a horizontal channel is not to be trading within the highs and lows of that horizontal channel. It is to trade on the exit below the channel or the exit above the channel, to either go long for a move above or short for a move below, using that channel line as your stop area. So if we were to draw this current horizontal channel off of our highest close, our lowest close during the consolidation period, the trade to be made should we go above would be with a stop of 45.98.19, and should we go below, the short trade with a stop using the resistance of 45.52.29. This is Coach Mike with winningstockcoach.com, encouraging you to check out the Coach's Roster newsletter, where you'll find me live in our trading chat room each market day and live in our evening sessions for our weekly webinars that we do. Good luck in the upcoming trading week, and God bless y'all.